Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Ball Corporation, ticker BLL. Over the next 5 minutes, I'll discuss both my thoughts on the valuation of this company and what I think the company's business quality is. Now, let's dive right on in. First thing first, we see this is the containers and packaging industry. So they provide aluminum packaging products for the beverage, personal care, hospital, household products in the U.S. and throughout the world, Brazil, internationally. They have beverage packaging, North Central America, beverage packaging Europe, beverage packaging and aerospace. So primarily beverage packaging. They sell aluminum beverage containers to carbonated soft drinks, beer, energy drinks, and other beverages. Sounds like they sell the stuff that goes into Coca-Cola bottles, type things like that. Coca-Cola and Pepsi, if I had to guess. They also design, manufacture, and test satellites, remote sensor, and ground station control. So really interesting, two different business models here, but they seem to be quite good businesses. The beta of 0.499 is really interesting because that's a really low beta for an S&P 500 company. Suggests that they're going to be relatively low volatility, which could mean that they might be relatively attractive from a quality standpoint. First thing we see on return on invested capital suggests that they would be quality because it's 20 straight years of profitability. There's not a single loss in that year. That's very attractive. However, we've seen a general negative trend line in their return on invested capital, and that negative trend is relatively poor for you as an investor. You don't like to see negative trend lines in return on invested capital. Not only is it negative, but since 2010, they've not had a single year with 10% or higher return on invested capital, and that's quite poor. Now, you did hit a bottom of 3% in 2016, and you've come back up to 7.5% in 2021. So you have some improvement over the last 5 years, but it's not enough to make me really attractive. So this does not look good from a quality standpoint. Now, we go to 10-year median returns, we see return on assets of 3%, return on invested capital of 5%, but return on equity of 20%. So there's probably a lot of leverage here to help you get that number, and that introduces some risk in the business, but if it's properly managed, could be quite hopeful. So we would need to understand what's going on there. Now, PE of 20 is quite high. For something like this is not super attractive. So you'd either want, good growth or something like that. And you can see the problem and the reason the return on invested capital is declining. You had revenue growth of 4.8%, but asset growth of 10%. If you maintain that over a long period of time, then you're going to continuously get worse return on invested capital if your assets are growing faster than your revenues. You're going to have negative operating leverage. All that's going to impact it. So you see that we have declining free cash flow over the last 10 years. EPS has grown at 7.3%, which is okay, but not as attractive as I'd like for a PE of 20. If you're enjoying the content so far, please hit that like button and hit subscribe. And if you subscribe and ring the bell, then you can get notifications as I upload new videos. Now, let's go to the income statement. And here on the income statement, we can learn a few more things. Gross profit has been growing. Operating profit growing and profitable the whole time. That all looks good. Now, you have something weird going on with shares outstanding. You started out at 309 in 2012. You dropped to 298, dropped to 277, dropped to 275. For the first 3 years, you're declining shares outstanding, and then you start jumping up again for a few years from 2015 to 2016 and 2017. Maybe they issued shares due to an acquisition, or maybe they're doing some stock-based comp. I would hope that's an acquisition. And then in 2017, they've been declining again from there. But either way, across the whole decade, you actually have increasing shares outstanding. Let's go to the cash flow statement to see if there was an acquisition here. And we can see in 2016 there was an acquisition for $430 million, and they probably issued stock to do it. It doesn't say they did, but I can't imagine where else this came from. Do we have stock-based comp? It doesn't show as stock-based comp. They don't show any stock-based compensation. So something weird is happening with this acquisition and this other that's kind of messing up the numbers we have here. Now, we do see that they've been paying dividends, and the dividends have grown quite strongly over the last few years. So that's a good sign. They've been growing their debt as well. We should be able to see that on the balance sheet. Now the PP&E, you've basically tripled your PP&E from 2.2 billion to 6.9 billion. You've almost doubled your goodwill from 2.2 billion to 4.3 billion, and that's that big jump in 2015 to 2016. You see that acquisition taking place. Now, retained earnings have been growing over time. That's always good. You see this big jump in assets. So your assets, here we go, 7.2 billion in assets to 19 billion in assets. But if we go to the income statement, you've only grown, 396 million to 1.1 billion. So 1.1 billion against this new thing, you have like a 5% return on your assets. That's not that strong. Now, the reason it works out is because they have a lot of liabilities to offset those. They have long-term debt of 7.7 billion. So they're completely offsetting and covering their PP&E with debt, even more debt than their assets, especially when you take into account that their goodwill's here. So your tangible book value is negative because you have more goodwill than you do shareholders' equity. In this business, you're covering the whole business with debt. Now, that is why you're getting this high return on equity, which is allowing you to probably do all right in terms of returns despite having these low return on invested capital. So management is seemingly managing this business well, but I don't like it. So you can see some cyclicality. I don't like how the returns have gotten worse over time. I don't like that the revenue growth is only 5%. You're going to struggle to earn double-digit returns because you have an earnings yield of 5%. You have a revenue growth of less than 5%. You're basically the math's going to take you out to something like a 10% return if you're lucky. But with these low returns on invested capital, especially if interest rates rise, this company is going to be in a lot of trouble. I don't like what I see in terms of this business. So for me, it's going to be a pass. It won't hit my watch list. It's a little too low quality, and the valuation just isn't cheap enough to justify investing in the company. If you enjoyed this video, please like it and hit that subscribe button. Don't forget to ring the bell so you can get notifications as I upload new videos. Thank you for listening, and until next time, stop paying fees.